You might have heard recently phrases like 50-year mortgages and no minimum credit score. Sounds like easier approvals, tiny payment, right? Not so fast. I'm ReAnn Gonzalez with Edge Home Finance. If affordability is crushing your deals or your clients are confused, this video will bring clarity. I'll walk you through a $300,000 loan at 6%, show you the payment gap, total interest cost, and how fast equity really builds. And I'll reveal the one mistake that can cost tens of thousands. Okay, so now let's get into it. Here's the deal. First, the 50-year mortgage. This long-term loan is designed to lower the monthly payment compared with a 30-year. That lower payment can help you qualify and breathe each month, but lenders may price it higher than a 30-year because the risk stretches out longer. Second, the no minimum credit score. Fannie Mae announced they are removing this from their automated underwriting system. Sounds like you can breeze right in. Not so fast. While the score itself isn't the blocker, underwriting still reviews income, debts, payment history, and reserves. This isn't a no-doc shortcut. Documentation still matters. For borrowers, the affordability piece. A longer term can mean the difference between renting and owning. But, and this is key, it also means your equity builds slower and you'll pay more interest over the life of the loan. For agents, yes, you might see approvals, but the timeline for moving up may stretch because your client's equity will grow at a slower pace. Set expectations early. Let's talk math. $300,000 at 6%. Here's the side-by-side you need. On a 30-year loan at 6%, your monthly principal and interest is about $17.99. On a 50-year loan at 6%, it drops to around $15.99. That's roughly $200 a month back in your budget. Feels good? But look deeper. On the 30-year loan, you might clear the first $50,000 of principal in around 8 years. On the 50-year, it could take 20 plus years to hit that same $50,000. More of each payment goes towards interest for longer. Payment relief now, slower equity later. Here's where most people get burned. They chase the lowest payment and assume they'll refinance later. Maybe that works. But if rates stay high, what if the 50-year is priced higher from the start? The math never lies. My fix? Treat a 50-year as a bridge, not a forever loan. Pair it with a concrete 3 to 5 year plan. Set equity checkpoints. Make extra principal payments, $50 to $150 extra a month if you can. Use seller credits to buy down the rate when possible. Compare 3 options side by side. 30-year versus 50-year versus 30-year with a temporary or permanent buy down. Run the break even on points versus monthly savings. Now, let's talk about that no minimum credit score claim. Good news, it opens doors, but the underwriting still cares about income, debt ratios, credit history, stability, and reserves. For borrowers with thin or non-traditional credit, build your non-traditional credit file with on-time rent, utilities, phone, insurance, documented and verifiable. Clean up collections, pay down any thin file issues. Approval isn't the same as true affordability. Budget for maintenance, emergencies, so you don't end up house poor. So here's your takeaway. The 50-year mortgage lowers your monthly payment, but the real cost is slower equity growth and much higher total interest. Use it as a bridge, not a destination. If you're a buyer, message me and I'll build your side-by-side plan with equity checkpoints and a credit roadmap. If you're a real estate agent, let's build your client pre-brief kit so your offers land fast and clean. Reach out today. Thanks for watching. I'm ReAnn Gonzalez with Edge Home Finance. Subscribe now if you're not already, and I'll catch you in the next video.